Hi everyone. In this session, we are going to discuss about the balance sheet. So, what is balance sheet? Balance balance sheet shows the financial health of the status or position of the business entity. Tells from where the funds are coming from and from where the financial arrangements are being made and where the funds are going or how they are being utilized. So it helps the owner of like financial institutions and others who are concerned with that to know about the health of the business entity. So balance sheet is nothing but it is a snapshot of the financial parameters available in the business entity. It keeps on changing every time, every moment, but there may not be major changes in few hours, but on the other side, it is as on particular time, as on date. So you have to specify as on which date this was the position because it keeps on changing with time. So some people they call it it is a statement of sources and applications. Some say it is a statement of liabilities and assets or assets and liabilities. Some say that it is nothing but it tells us what is owed to others, owed WED, or whatever you have to pay to others, or and what you own, OWN, or what the business is having with it, which is its own. So this is a statement which tells this thing. Some people say that it is nothing but project cost and means of finance with slight variation. What is that variation? That we'll discuss subsequently. So like that, ultimately it is the reflection of the financial health of the unit. Which tells us how the funds are being arranged and being used by the company, by the business entity or industry. So what are the various parameters or terms of balance sheet? See, liabilities and assets. Assets means what is owned, liabilities what is payable to others. Or this also reflects as sources, that is liabilities, and assets as applications. So this is so many ways are there. Only thing we have to understand what is if we call it statement of assets and liabilities. So liabilities you take left side and assets you are taking right side. So liabilities will tell us what are the sources from where the funds have come, and assets will tell how and where the funds have been used. So first thing on the liability side is capital oblique equity. Now what is capital? What is equity? Basically both are same thing with a slight difference that equity is normally used, this term is used for proprietary concerns and partnership firms, while the capital is used for private limited companies and limited companies, and it is nothing but a contribution brought by the promoters in the business. Then comes reserves and surplus. So reserves and surplus basically it is the accumulation of profits in the business as run by the business after or as per the profitability statement which we are going to discuss subsequently. Plus sometimes the revaluation reserves also added here, or if somebody has brought in patent or has a copyright or charging something or charging something for designs and developments or has some brand image. So those things, money paid to such fellow is also sometimes shown under reserves and surplus, but banks or financial institutions won't consider it as it is not money in real terms, so they won't take into account for doing their assessments and calculations and financial analysis or financial ratios analysis purposes. While the capital in the private and private limited companies and limited companies also includes the funds brought in by the shareholders, the shareholders' money is also included here. So sum total of capital or equity and reserves and surplus will give us tangible net worth. Now reserves and surplus in case of limited companies it is shown as separate account in this as a profit and loss account. But in preparatory and partnership concerns they don't show it as a separate account in the form of profit and loss account. They will just adjust in the reserve and surplus itself. Sometimes profit and loss account is shown on the right side, that is on the asset side. Then it means there is a loss for that particular period of time for which the balance sheet is prepared, or financial year. So profit and loss statement on the right side is a loss. Now the sum total of capital or equity plus reserves and surplus gives us tangible net worth T and W. Why tangible? Because intangible items like revaluation, reserves, copy, patent, brand image, payments are not included in this one. So this is tangible net worth. Otherwise, if it is included, then it will be intangible net worth. But for the calculation purposes by the banks and the financial institutions, only tangible net worth is considered. So T and W is nothing but tangible net worth. This is a very important parameter in financial terms. It will be useful in future in subsequent discussions. Then comes long-term liabilities. Now, what are long-term liabilities? Long-term liabilities means if the funds acquired are for meeting the fixed assets which are for long-term purposes and the repayments are not within 1 year, it is on long-term basis, then it is long-term liability. See, term loans again are defined as short-term loans, medium-term loans and long-term loans. Short-term is that will come under some other category, so it will not come under this category. Medium-term loan and long-term loans will come under this category, where the repayment period varies from 3 years to 7 years normally, but in some specific cases, just like in infrastructure projects, it can go up to 12 years also. Then comes if it is a public limited or a private limited company, they can accept especially limited companies from the public. The deposits accepted from the public is known as public deposits. So this is not applicable to preparatory and partnership concerns. So this is also source for the business entity. Term loans are also source. So these are liabilities. Because this is the business entity has taken from outside and they have to pay back. Then comes debentures or bonds, etc. That is also liability or source. Similarly, long-term unsecured loans, if it is for more than 1 year period, then it will be coming under this category of long-term liabilities. Then after that, after unsecured loans, this is 3 short-term liabilities or current liabilities. So normally term current liability is normally used. So this will include sundry creditors, advances received, short-term loans or working capital from the banks, and loans from friends and relatives, etc. etc. So what is sundry creditors? Sundry creditors are nothing but the current assets or stocks, inventory, raw material, etc. purchased on credit from the market and the supplier of these materials are known as sundry creditors. So this is a source for the company which they have to pay later on. So this is a liability, short-term liability and the creditors or current liability. Advances received. If the business entity has received some advances which they have to pay back later on, so those advances are also known as sources, short-term sources or current liabilities. Short-term loans, other short-term loans or working capital from the bank. If they are taken some short-term loan from the market or from the private sources, are also coming under this category. Similarly, loans from friends and relatives, if it is to be paid within a period of 1 year, then also it will be known as current liability. So sum total of long-term liability, capital and short-term will be the total of the liabilities for the business entity. Now on the asset side. Asset side means, so what are the company has acquired sources from different institutions, individuals, different companies. What are the funds are acquired, and how these funds will be used by the company. This will be known from the asset side only. So what are the assets? Just like fixed assets. So what are fixed assets? See, to run the company, there is a need for the land, building and the machinery to manufacture the product. Ultimately, what is the activity in the industrial activity or business activity? What is the difference? Business activity is you purchase something from the market and you sell the same with some profit. There is no manufacturing in this thing, there is no processing in this. But in the industry, what happens, you buy raw material, you process it on the machines or equipments, and then it will be converted into finished goods, then you sell in the market. So that process is required in the industry, and this is the difference between the industry and commerce. Commerce means only trading activity. Industry involves manufacturing activity or processing activity. So for that purpose you require land and building and plant and machinery. So these are, or any long-term investment if the company has made in some other companies, so that will also be included in this one. So this is known as fixed assets. Now after the fixed assets, that comes current assets. So what are the current assets? Current assets are those assets which are required to produce the product or finished goods, and they are saleable in the market. The fixed assets will be helpful in producing the current assets, and current assets are saleable in the market, or they are producing the products. They are concerned with the products, they are connected with the products. So just like we'll call it, raw material is one, then raw material is procured and processed, and when the material is in the process stage or stocks in process stage, that is also part of this one. and it will be converted to finished goods. So these all are stocks blocked in the process of manufacturing. Then after the finished goods are sold in the market, then you will be definitely giving it on some credit to the clients or your customers. As you are in the competitive market, you cannot sell it on cash basis. You have to give some credit. So some sundry debtors will be there. Sundry debtors means those who have procured material, finished goods from you, and they have not made the payment so far, and funds are blocked there, and which are payable to the business entity. So that is sundry debtors. Or it includes bills, receivables, or book debts. The only basically same type of funds, but only terminologies are different due to their different nature. Then comes cash and bank balance in this category. That will also be added, because whatever the cash is available in the bank, that is also an asset only. Then non-current assets. So these current assets are usable for producing the products only, or finished goods, which are saleable in the market. But non-current assets, they won't come under the category of fixed assets or current assets, and that's why they are known as non-current assets. These are assets just like jigs, fixtures, tools, spare parts, etc., which are not a part of the finished goods, or not a part of the machinery also, but it is in between, used for producing the product as a tool, or a holding tool, or cutting tool, etc., or spare parts. So these assets will come under this category. Over here, cash and bank balance and advances paid also can be included here. If the business entity has paid some advances to its suppliers of raw material, because some of the materials are not given on credit basis, so there's even sometimes advance is to be paid, especially when the item is important, or has to be made as per the order, or tailor-made products, you can call it. Then it is advances are paid. So this also is a part of current assets. So non-current assets already have covered. Then miscellaneous assets. Some of the other assets which do not fall under the category of fixed assets, current assets, and non-current assets. So they will be coming under miscellaneous assets category. So in the miscellaneous assets category, what is included here? Just like say if the company is making loss, limited company or private limited companies especially, profit and loss account will be part of this one. Okay, it can be separate also. So you can show here for some tiny losses or some tiny issues, related things, some suspense accounts, etc., can be part of miscellaneous assets. Or some small short-term investments made by the company in some other companies or associates can also be part of this asset. So both the sides, sum total of assets and liabilities, both sides should be equal. So if the say liabilities are 10 lakhs, then the assets also should be 10 lakhs. If it is not matching, then there is some mistake, or it may be topographical error, that should be rectified. So this is a brief about the balance sheets. In general, I covered it in a very simple manner so that the basic concept should be clear. If these basic concepts are clear, then if some complications are there in say limited companies, some more items are added, then that will not be a problem for you to understand, because once the basic concepts are clear, then everything is clear. So this is over. Then I have included to understand the balance sheet in a better way and to understand some of the terminologies of it, which will be helpful in finding out the utilization of funds, whether they have been done in a proper manner as per financial discipline or not. Then how we will come to know all those things. So if it is shown in the graphical manner, then you can easily understand and you will appreciate that. So if you have understood it, then you can help others also to understand the same thing in a better manner. So some of the things, some of the parameters we will cover in this thing to understand the graphical representation, which you will not find in any book. Very rarely it is prepared. From my experience, I have prepared it. So graphical representation, again, we can show assets and liabilities. So this is actually liability side, so it is not assets. This is the liability. Other side it is asset. So liability side, what are the liabilities? These are long-term liabilities and short-term liabilities. Short-term liabilities are also known as current liabilities. Then on the asset side, there is fixed assets, FA, and current assets. So non-current assets are also included in this one, current assets. So this is just a graphical representation of this thing. So now what you are finding here, this shaded portion is, what is it? So this shows long-term sources, long-term liabilities. A portion of that long-term liability will go towards the acquisition of current assets, as the promoters they have to bring in margin, their margin, as prescribed by the bank or financial institutions. So long-term sources will go towards meeting the fixed assets, and a small portion will go to meet the current assets. And the short-term liabilities will completely go to meet the current assets. If this is the trend, if this is the way funds are flowing in any particular balance sheet of the company, then it is a accept as per the financial discipline. Because short-term funds are taken from the market are to be used for current assets. If it is not used, then what will happen? That we'll see in the other figure. So here current assets minus current liability is nothing but this shaded portion is nothing but we call it liquid surplus or net working capital or partial promoters contribution, because complete contribution of promoters will be this contribution plus some of the contribution is gone towards the acquisition of fixed assets. Or if they are taking term loan, so there also they have to bring in margin, so that will also come from the long-term sources. So that's why it is a partial contribution of the promoters. So if this is not happening, then say I have given another figure here: long-term liabilities, current liabilities, fixed assets, and current assets. Here there is some difference in the figure, above figure and this figure. So here long-term liabilities are less than fixed assets. So fixed assets are here up to this point. So these are current assets. So these are fixed assets, which includes this dotted portion. So what does it mean? It means all the long-term liabilities have gone to meet the or to acquire the fixed assets, and current liabilities are going to meet the current assets, plus a portion of current liabilities is going to meet this shaded portion. It means current liabilities are more than the current assets here. So current assets plus this shaded portion, that is equivalent to current liabilities. But the current liabilities have been given to me to acquire the current assets as it is for short-term basis. If it is done, then what will happen? It means the company will not be in a position to pay back this money immediately. It will have financial crunch, because whatever the funds are blocked here, that is for short-term basis, but whatever the funds are blocked in the shaded portion, that is going to acquire the fixed asset, that is for long-term basis. It means those funds will be blocked there, and the funds will not be available for the company to meet the short-term liabilities, and it will have a financial crunch. This is how the problem starts in the business. And if it is not controlled, it will increase further, and it will affect the production of the company, as the funds are not available, adequate funds are not available, and the sales will come down and the profit will also come down. So this is how the business is affected. And this is known as diversion of funds, because short-term funds have been used for fixed assets, which should not happen, which should never happen, because these funds are blocked for long-term basis now. And the business is going to suffer. So this is not as per the financial discipline as needed or as required by any business entity. This is the main reason. So this is known as diversion of funds from short-term sources to long-term applications. That is to acquire the fixed assets. So this must be avoided. Otherwise, it is going to create problems in future. So this is diversion of funds, what we call it. So we'll be discussing more about in funds flow statement with examples. Then things will be clear about diversion of funds. And then what is siphoning of funds? We normally talk siphoning of funds, diversion of funds, but many times we are not clear about it. What is the difference between these things? So diversion of funds is we have found out just like no. So this is diversion of short-term sources to long-term applications. This is within the business itself. This is clear from the business. This is clear from the balance sheet calculations will tell this thing. But siphoning of funds is not visible, that is invisible in this balance sheet, because that is done mainly based on the manipulations which are not reflected in the balance sheet as the balance sheet is manipulated. But that can also be found out. There are methods for that also, but not so simple as is not a simple calculation. Okay, you can do it from the balance sheet and you can find out what is the amount siphoned off. But there are other ways. Beyond that you have to go. Beyond the balance sheet you have to go. Then only you can prove that. So this is siphoning of funds and this is diversion of funds. So from here we can find out diversion of funds, not the siphoning of funds. So that I have made it clear, because most of the time these things are not clear actually. But we use these terms regularly without knowing the difference. So that's why I have given this graphical representation of the balance sheet. Then we will discuss further about the profitability statement or profit and loss account, which is also important aspect of the financial analysis. So what is that? We'll see. For processing it, you require machinery.